Why do lenders need to see my credit score? It's a question that has puzzled many before us, stretching back to the days of ancient philosophers pondering life's mysteries. Credit scores, much like the human appendix, exist within all of us, yet their workings and purpose remain somewhat of a conundrum.
I'm so confused.
So let's embark on a quick expedition to demystify the subject, addressing some burning questions along the way. What's the deal with credit scores anyways? Why do lenders see a different credit score than I do? How does my credit score influence the interest rate I get? Any pro tips for boosting my credit score?
Too many questions.
We'll start at the beginning. What's the deal with credit scores anyways? Think of a credit score like a mirror, but instead of showcasing the mythical deity of your reflection staring back at you, this mirror reflects your financial habits over time. Credit scores are a numerical value assigned to your creditworthiness based on a couple of different factors like payment history, your track record of timely bill payments, credit utilization, the ratio of your credit use, length of credit history, how long you've had that credit, new credit inquiries, the frequency of your credit applications and new account openings.
I'm so confused.
Each factor influences your score to differing degrees, but together they weave a complex tapestry. Some tapestries are gorgeous, and some, not so much. Why do lenders see a different credit score than I do? Ever scratch your head wondering why the score you pull up online doesn't match the one that we show you? Well, it boils down to a myriad of scoring models in play. One score in soccer is only 1 point, but it's 2 and sometimes 3 points in basketball.
Boom shakalaka!
In the same way, the scores you see are different sport than the one that we're using. The score you see is a surface-level credit trend, like doing a DNA test on a piece of dandruff. Gross. Whereas hard pulls for things like a mortgage or a car loan are like pulling blood directly from your veins. They focus on different credit history facets, which is why there can be such a discrepancy between the two scores. How does my credit score influence the interest rate I get? Just like the story of the 3 little bears, there isn't just one credit score. There are 3, and each of the credit bureaus will give you a different score based on their own modeling. We use your middle score to price out your interest rate. It's not about the highest or lowest score, but the one in the middle, perfectly balanced, just right for making that crucial decision. And that's why every point on your credit score matters. See, lenders group scores into bands of 20 points to set interest rates. Someone with a credit score of 759 is in the same boat as someone with a 740 when it comes to the rates they'll get offered. That means that even a single point can bump you up to a better rate or drop you down to a higher one. So here are a few pro tips for boosting your credit score. Credit utilization wisdom. Strive to keep your card balances below 30% of your limits, ideally between 5 and 10%. Punctuality pays. Late payments are a no-go. Keep those bills paid on time to avoid dings to your credit score. New credit caution. New inquiries and accounts can sway your score, so tread lightly with new credit applications. And that's a wrap. You did it.
Yes!
Now all there's left to do is to click the link in your portal, pay for a report, and let's see what sort of tapestry we have to work with. I hope it's pretty. But before we say goodbye, remember, we're here to arm you with the knowledge so you'll navigate the financial maze with confidence. And if you need us, reach out. We always got you, boo.